Hello Propenomix people, and welcome to the Sunday supplement from the 25th of February 2024. And I've called this week's edition Bankenders for reasons that will become obvious. So as you'll know, I like to start off with a quote, and this week's is: inflation. It is always and everywhere a monetary phenomenon. It's always and everywhere a result of too much money, of a more rapid increase in the quantity of money than an output. And that's from Milton Friedman, possibly the GOAT in economics. Certainly when it comes to inflation. Now, before we get stuck in for real, Rod Turner and I are running a free online Partners in Property Pip Taster event on Monday the 26th of February at 7 p.m, and this is the last call. We're talking about the property puzzle in 2024, taking on a whole number of topics including stacking deals in the current environment, rents, house prices, financing arrangements, and the likely impact of the upcoming general election, amongst a number of other topics. It's 90 minutes long and free to air. It's not going to be recorded and it's not going to be repeated. Sign up gratis at the link in the show notes. So, off to the races we go. After the smorgasbord of the past couple of weeks, there's a healthy side salad of macro for this week, and then we can get stuck into the Bank of England committee notes from their appearance in the House of Commons this week. I attended their breakfast briefing this week and, as usual, had some annoying questions from my chosen position on the front row. Yep, I'm that guy. You knew that anyway. So I'll find a way to weave those in at the end. I've had to hark back to something that's still surprising me. Even in a room like the Bank of England regional briefing, with a whole variety of the great and the good in the wider Warwickshire area, and also me, it is evident from much of the audience participation that they still just don't understand inflation. In fact, too many of the attendees don't really understand the bank's remit and ask for opinions on politics, the stock market, etc. Luckily, the regional representative shuts them down very quickly, but very nicely. However, even with clear and detailed slides on the screen explaining inflation, the impact overall, 20 to 25%, with some variability of course since the pandemic started, is simply largely forgotten. Are we so entrenched in nominal thinking? Is it the fault of the cheap money era, with everyone forgetting what inflation really could do? Is it something else? I'm not sure, but that's my cathartic rant out of the way, or at least introduced anyway. Before I get right back into the detailed quarterly bank report, I'm going to get into the macro of note this week, as always. 4 choices, 4 topics. That sums up my subject matter for the supplement on the macro front these days. This week, the bond yields. Spoiler, up front this time around. The flash PMI numbers, which I love to follow for their predictive powers, consumer confidence, and concluding with the buffet of Bank of England MPC members and their pronouncements at the House of Commons Treasury Committee. Kicking off with the yields then. A 5-year gilt sale this week sold well over our magic threshold, into our expansion territory, 4.1% at first issue. That was a snippet of value there since we opened the week at 4.015 and closed it at 3.932, after a late buzzer-beating smash well below the magic number in Friday's trading. It really was quite low volatility and devoid of incident. Some activity after the flash PMIs, which I'll get into, but it simply got blown off again. The swaps have been trading a tiny bit under the gilt yield, showing a market that is still relatively devoid of mass new loan appetite, for simple mathematical reasons. Until rents are up considerably more, for retail investors, they stack the average deal and walk away because either it doesn't work or it doesn't look like it used to be. On to the flash PMIs. Remember the formula: services plus manufacturing equals composite, but not in equal proportions. Services are about 6 times the size of manufacturing in the UK these days, from a GDP perspective. The services PMI held up at a buoyant 54.3. 53 is a very healthy score from a long-run average perspective in a decent economy, so 54.3 is comfortably on the right side. That held the composite score up at 53.3 versus a consensus of 52.9, so the economy is still ahead of what was expected. And this was the one bit of macro news this week that was released that pushed the yields beyond 4% for a sustained period after the news was released. But as I've said already, they did come just back under 4% comfortably for the week's close. Manufacturing was up from the previous month but under the consensus forecast, but due to the much smaller share of the index, it didn't make much of a dent. The number was 47.1, so the sector continues to shrink for the moment from a PMI perspective. Consumer confidence stats next. Last month was a surprisingly improved outlook given the continuing challenges the consumers are facing when getting used to a new world of pricing. Thoughts were for roughly the same print as last month, and that's pretty much what we got. A couple of points lower at -21. Remember, 0 would be neutral, compared to a forecast of -18. Most of 2022 was spent between -30 and -50. Most of 2023 was -20 to -40. So you can see we're still printing more healthily than that. If you wanted to draw a conclusion from last week's supplement regarding recessions, you might say that I highlighted the toughest time as Q3 21 to Q3 22 for households. Q3 before we reached the net low, but Q3 23 before we got back on an even keel. So we lost a couple of years of economic progress in the wake of the pandemic, which, all else being equal, is actually an incredible result, compared to GDP per capita recessions or just GDP technical recessions. My focus in that analysis is on the people and not the entire economy, and might well explain why the consumer confidence stats pretty much track that analysis. We're starting to print numbers on the confidence index that look more like when we went into my definition of the tough times, Q3 2021, but seem at the other end of the curve. If we took a parallel between the UK and the US, their technical recession in 2022 that was erased, probably correctly from the history books by their senior economists, has certainly not held back GDP growth at this time, although their real household disposable income equivalent had a massive boost with the stimulus checks and pandemic response in 2020 and early 2021. But they went on the same journey with their household disposable income, in that there was no growth between February 2020 and June 2022. Although the growth since June 2022 is 6.2% for the average household in real terms. With wage rises expected, suggested and enshrined this year, the UK could look relatively similar within 3 to 6 months, as April 24 is D month for wage increases and benefits increases. So we might be more confident about confidence, but, and no wonder people cite mental health pressures more and more, the Consumer Confidence Index has not been above 0 since January 2016. Pretty tragic from a fragility perspective. So on to the Bank of England speeches this week, before getting onto the report. The important one, of course, the important chess piece is deemed to be the Governor. There's been a very sensible spate of speeches recently by the Governor, and I'm reconciling the fact that I agree with a lot of it, with the fact that someone else writes his speeches and he's just the mouthpiece. It is also a lot easier to predict what's going on from here, from where we are today, compared to the volatility of the past several years, and so you'd expect our opinions to start converging somewhat. His rhetoric at the moment is effectively the market forward curve, that's the assumptions on future rates, looks about right. This is consistent with his narrative that the bank has done the right thing, which of course he would say, but also the bank has been proven to be correct, in that the market spent a lot of time overestimating the terminal interest rate for this cycle in the past few years. However, here's the opportunity for my big short moment. The world just isn't ready for the UK economy, or any of the bigger boys, to need to put rates up from here at this time. The probability is small, but there are a lot of little things going on that are not congruent, especially in the UK, with inflation coming back to target. Wages is the biggie. The trend is downwards, and it will be, but not downwards very fast at all. Here's the most basic summary I can give, which will still be remotely useful in the context of this conversation. Wages up 5 to 6% this year, probably. Benefits up 6.7, pensions up 8.5. Food prices have come downwards, but are getting back to a place where they will probably go up slowly again. Energy hasn't reached its low yet. That will be July this year, all else being equal. The risks remain to the upside, and another geopolitical upset, including a healthy 20 to 25% chance of escalation in the Middle East, some of the analysts say. I'm not even going to attempt to give my own view on that probability. I've got nowhere near enough info, and I haven't done the work. Lazy, I know. That would mean all bets are off, though, and we are coming from a fragile situation in the first place. The size of the problem would be directly proportional to the size of the escalation in any geopolitical conflict. Oh, and services inflation is still roaring well above 6%, and the downward trend, frankly, just isn't there. Sideways, yes. Downwards, no. That's not the recipe for 2% inflation. Arguably it is, according to the bank, over a 3-year period. OK, if you just calmly draw lines downwards on a graph, I agree, but let's face it, real world economics doesn't happen like that. Ergo, what's the chance, or what's the certainty, that we've reached our very top base rate here? A lot of those reading or listening might be thinking right now, oh, I thought that was pretty much guaranteed. And listen, it is the overwhelming favourite. I'm not trying to scare anyone, just explore what might happen in this sort of scenario. 20 to 25% feels like a high probability to assign to more rate rises, the same probability the Middle East escalation, and I think more likely 10 to 15%, because some of that escalation might not be enough to knock the train off its tracks. What happens if the chainsaw guy, check for the videos if you haven't seen him, the still new Argentine president, decides the Falklands are coming home, for example? 10 to 15% is still uncomfortably high. That's between 11 to 2 and 9 to 1 for those who prefer Old English betting odds. The reaction could be really considerable because it would really bring uncertainty back to the table. Specialists in high volatility, low probability, significant outcome trades, like Brownfield Capital in that great movie The Big Short, and I suspect you'd find a few hedge funds betting on this outcome at the moment if they can be getting odds like 20 to 1 or similar against these outcomes. Likely to lose, but massive payoffs if they win. Extracting expected value. So we have to press on with a mentality around those risks. To listen to the governor, back to him, those risks are not really being flagged anymore. That's uncomfortable. The remaining conclusions from him are that the labour market is strong. It is, but our measuring stick, or the ONS's, is up the spout, which is worrying. And ultimately, unemployment is low because sickness is high. There's an alternative view for you. And that's the issue with just watching unemployment. Employment is 1.2% below the pandemic, which feels about right. And the bill that imposes on the state is significant. It's part of our fiscal drag following the pandemic. So a quick word about the others as well. The others to speak this week were Dr. Ben Broadbent. He's the Deputy Governor for Monetary Policy, so Bailey's understudy when it comes to the interest rate. And also Dr. Dingra, the one remaining dove on the committee. And Megan Green, who I analysed last week, the one who's closest to my current views on rate decisions. They get called to the House of Commons to give oral evidence on the most recent monetary policy report. I couldn't even attempt to analyse this line by line, so I've tried to draw out the punchy parts of the evidence. I warn you in advance, the whole transcript is 36 pages long, and I've analysed the whole thing. It opened with the chair, a Conservative MP of course, basically asking for understandable reasons, looking for looser economic policy to help election chances, let's be honest. What will it take to get rates down then? There was a reminder that the economy is basically at full employment from Bailey, which, as above, it isn't when you look at actual employment figures. We might be using all the people we've got at this time who are looking for jobs, or something convoluted like that. There's always a bit of an allowance for structural unemployment, people in the wrong places, people with the wrong skills, all the rest of that. But really, it just means a tight labour market because a lot of sick people are in there who are on benefits instead. Broadbent proceeded to throw the ONS's recent data quality issues around the labour force survey and unemployment under the bus. Not entirely unfair, but it doesn't help anyone. Next question to Bailey was, why is the forecasting so rubbish? And he dodged it, citing the Ben Bernanke review, which is being written very hard. Yes, that's really what he said. And will be with us mid-spring. Time before the next committee to think of some excuses then. They pushed him into saying the report will be with them in April. Green then said she needs more evidence to change her already changed vote from rise to hold to cut, citing wage rise concerns, rightly so. I'm struggling to see personally how the math plays out when the falling prices, just taking their time to come down from their temporary peaks, hit their bottoms. Already have or will do in a couple of months, food, or will do in summer this year, energy. Dingra is different. She wants to focus on the trends being downwards in consumption activity. It's such a big part of the economy, I do see her point of view. 60%-ish of nominal GDP, 62.5% or above sometimes, depending on who's doing the measuring. That's significant if you're trying to curate GDP. It's obviously not the stated objective of the Bank of England, but it's a bit like not expecting the CEO, the execs and the non-execs not to manage the share price. especially if the share price is part of their remuneration packages. It isn't at the bank, of course. She doesn't want to loosen too late. The others don't want to loosen too soon. Rather than drive a truck through any individual's opinions and statements, which is relatively pointless and somewhat unfair, especially given their level of qualifications in the field, we might simply be able to suggest that as long as the mix on the committee is right between hawks, doves and realists, then we're okay. Migration and growth were other questions, of course, but really outside of the bank's remit. The committee's opinion on those matters is exactly that, opinion. Discussing how good or not GDP and other figures are is interesting, but ultimately useless. There are no active proposals to change those measurements. Bailey reiterated the bank's forecasts are based on the market's forward curve predictions on interest rates, where they settled just before the meeting. This is necessary, otherwise their forecasts become circular. However, rather than cross-sectioning, they should blend or average somehow from the weeks leading up to the meeting. I suspect this might make Mr. Bernanke's report. So if it does, you heard it here first in the supplement. The bank actually doesn't mention this, though, when getting roasted for forecasts of gigantic recessions. This was against a backdrop of a market expecting a 6.5% base rate. If base rate had gone there, I think it's safe to say things would have been pretty ugly. Instead, the bank was right in that scenario and didn't shout about it enough. The market had gone way over the top just because Liz was, indeed, a bit of a lettuce. Stephen Hammond then spent a lot of time talking about how the Fed were better providers of forward guidance than the Bank of England. I think that's hogwash, really, because Powell and Bailey are both poor communicators and poor follow-ups to other great central bankers of the past for both banks. Broadbent disagreed with the forward guidance calls. He reminded the committee of the data, not dates colour around future rate cuts. In summary, there will be some, at some point of some depth. That's all anyone's getting right now, because if and when things change, the committee will change their mind. The strength really is that no one is asking that question at the moment, could rates go up? And so the MPC don't have to answer it, because everyone's assumed they're not going up anymore. Yep, that's twice I've mentioned it now, because I'm uncomfortable about any assumptions around no more hikes in this cycle. Hammond pressed on asking for dot plots or opinions on dot plots. The dot plot is derided in the US by decent analysts, so it would be difficult to support. For those who don't know or haven't heard the term, it is quite literally some dots from each member of the Fed committee in terms of where they think rates will be over the next several periods, including a couple of years and beyond. Educated guesswork or what? Hammond is trying to force forward guidance, basically. Green wasn't against them, but says they're interpreted incorrectly, which I agree with. Dingra also wasn't against them, but suggested that it might help draw focus to the medium term rather than the immediate term, which might be a good point, although I'd argue it shouldn't take a dot plot to do that. Coffey then raised some pretty ridiculous points when Bailey pointed out that a war in Ukraine changed things quite significantly. Coffey didn't know enough to point out just how much had changed plenty before the Ukraine war. Energy prices had been on the up for 12 months, for example. Ukraine was a reasonable sized shock to an economy that was already fragile. Bailey got the better of that exchange. That's Coffey's economic nous distilled very quickly. Bailey swerved her question on whether raising minimum wage so much was a good idea or not, or had an impact on the wage growth concerns. I mean, of course it does, for goodness sakes. He said that pay negotiations should come down as inflation expectations come down. However, again, no one knows enough about the data to challenge this. Inflation expectations were 3.5% for 2024 and are now up to 3.9%. Overall wage expectations by firms are 5.3% or so for 2024. So, firms have to find other savings. And remember, energy costs are coming down for firms too. It does depend on how accurate they are on wage predictions and, of course, how staff-heavy various companies are, of course. Perhaps that can add up, all else being equal, which is handy and also unlikely. Some of this also depends on whether they forecast how much salaries will go up or how much the cost of employing people will go up, because those are two different things. Because salaries go up, but also employers' national insurance contributions increase, and so do pension contributions, which are not directly part of salary, but they are part of staff costs, of course. Anyway, Coffey continued to embarrass herself by not knowing how the committee had generally voted. Going down the line, there hasn't been a healthy level of disagreement was just wrong, and she was told as much. What a waste of time. Barron then asked some much tougher and better questions around whether policy was overly tight. He was set straight that the current thought is that when the steam comes out of energy and food once and for all, that isn't dragging CPI down anymore. The CPI picture is so poorly understood, as I always go banging on about services inflation, for example, making up 47% of CPI. Green supplemented this discussion very skillfully, though, with reference to true economic history. Can you tell I'm becoming a Megan Green superfan? Her point was, loosen too soon and you get a US of the 1980s where you need to tighten further and that hurts growth more for longer. This all tracks back to why she was right and why the Hawks were right back in September 2023's meeting, and we should have gone to 5.5% as I've said all along. All that's cost us is an extra 3 to 6 months at higher rates over tight than we would have had otherwise. Remember that vote was 5-4 in favour of holding at 5.25, making Coffey's question on consensus look all the weaker. Barron then focused on QT, quantitative tightening, and bravo, this rounded an excellent bit of questioning from him. I've made it no secret that I disapprove. He nailed it by confirming it's a leap in the dark. He didn't quite get into the detail I would have liked. I'd have to be carried out at one of these meetings by security detail, of course, because I'd be like an express train. And got told that the committee believe they're doing the right thing, basically. Which of course they do, otherwise they wouldn't do it. I think they're wrong on this one though. Barron's final question was about groupthink in the context of Brexit. He nailed it, but the committee 8 years later on has different people on it, and Bailey, to his credit, has never taken a position on Brexit, the only place where he is superior to the previous governor, simply because it isn't within his remit. He is more limited than Carney, but that also leads him to stay in his lane too. Bailey confirmed also that the MPC doesn't anticipate any fiscal policy, it only reacts to it. Probably the right thing to do on balance. Passive-aggressively, it seems to say to me that, just remember when we had to sweep up after Liz, for example. We don't trust you folks at the moment. And who could blame the bank for that? Bailey's answer actually made a real mockery of the government, to be honest, who will be paying with lettuce banter for many a long year. Before reading these minutes, I'd never seen the Bailey get the better of anyone before, not even a reporter, but he made mincemeat of a couple of these MPs. That simply leads me to be even sadder at the state, or the standard, of some of Parliament right now. Some of these have or do hold ministerial roles as well. Sigh. Mather accused them of seeking a recession, raise till they break, what was said in the US, of course. That is, after all, technically what has happened. Raise and the recession has come. Bailey held hard with the stance the bank has done its job, targeted inflation. Coffey resurrected herself by pointing out, presumably after looking something up, that Broadbent has never voted differently to Bailey. Finally, she scored a point. She messed it up by mixing it in with the point that was supposed to evidence that the bank do forecast fiscal policy, but actually was corrected that the bank was simply following what the stated fiscal policy was, not anticipating it. Another own goal, and she slipped back to 4-1 behind with 5 minutes to go. The ONS and the Labour Force survey went under the bus one more time, and we learned that the ONS are not releasing the new Labour Force survey until September. This is not ideal, really not ideal, because we could do with a more accurate picture of what's really going on in the labour market at the moment. It's down to vacancies and observation right now, I'm afraid, rather than the headline data. Although, as I've argued many times, we look at the wrong bit anyway, because we should be looking at employment. The most definitive statement on the back of all of this was from Megan Green, who says she is reasonably sure the labour market is going in the right direction. That doesn't sound that sure, does it really? And that's appropriate at this time, I'm afraid. She got away with it. Presumably there are fewer points to be scored by slicing a piece off Ms Green anyway. Dingra offered an excellent alternative viewpoint. She pointed out that it was lower income sections and areas seeing a rise in inactivity. This potentially incendiary point was glossed over, perhaps lost on at least 50% of the committee. Let me do what no one had the presence of mind or the guts to do from that statement. Potentially any or all of the following. Number 1, people in lower social demographics are more likely to go on the sick when there's an opportunity. That's about as far right as I could possibly make that statement. Number 2, in lower income areas, the businesses also tend to be less profitable, and thus when there are large increases in costs, they cut recruitment faster. Number 3, forcing minimum wage upwards aggressively in areas of lower income leads to more unemployment, or alternatively inactivity, in those areas. Number 4, productivity suffers when minimum wages move upwards aggressively, particularly if paired with workforces that are disengaged, quiet quitters, dead-end jobs, and or suffering with longer-term mental health issues thanks to COVID. I could go on and on here. These aren't exhaustive, nor are they exclusive. However, I really like Dingra's line of thought here, going on about the productivity side, rather than sticking at the base level of what we can see in statistics, that sometimes are simply not that accurate. She uses the words really serious productivity issue, and no one has the presence of mind to press further, and instead they take the discussion in a totally different direction. Head in hands again. The next point was about bots in market, which I can be fairly confident that neither the questioner nor the questionee knew much, if anything, about. Centering on energy pricing, Bailey pointed out this is simply flagged as a risk, the Middle East and the Red Sea, rather than forecasted, which is a point already made, and it's the only sensible way to deal with it. The risks are deemed to be priced in, even if markets have a history of being poor at pricing in extreme events, historically. Broadbent then responded with skill to a Kruger question about oil prices going upwards in the event of escalating conflict, and talked about the larger second-order effects, i.e. what oil going upwards really means, other than the price of oil itself becoming more expensive. He also rounded off the point that is the deflation in goods coming out of China, perhaps due to the strategic move away from China for many governmental purchases in various Western economies. So prices have had to come down even more. Plus, ever cheaper nations applying pressure whilst trying to pick up the business that some of the West wants to move away from China is a good foil for the increase in container prices at this time. Dame Eagle then got stuck in with some good questions. We moved on to GDP per capita. Sadly, no one came in with RHDI, real household disposable income, as I would have hoped. I suppose these are only the theoretically top people in the country. Sigh number 3. It wasn't without merit though. Broadbent mentioned a large house builder that he had been to see in the autumn, who had a 30% drop in activity, but hadn't laid anybody off because they believed it was temporary and cyclical. This type of labour hoarding is not uncommon, especially in the UK, because workers are protected, and also in a tight labour market, the cost of recruitment can be huge. You can imagine though that it affects recruitment going forwards because it's a long time, as and when things get better, as they arguably already are, that business gets back to capacity or full steam. Eagle then tucked into the banks, 5% plus in interest rate rises, yet only 2.1% or so passed on to savers in the bigger banks. True, but instant access probably isn't a fair comparator. There have been plenty of 5 and 6% savings bonds out there in the past 12 months after all. Bailey pointed out that he had answered this in his Loughborough speech last week, which I referred to in a smaller way. He was discussing competition and his point of view that the bank shares looked cheap. He said this in a roundabout way. Once again I agree with him, and therefore I'm off to lie down in a dark room. Green confirmed that pass-through in the UK has actually been better than in the US and some other jurisdictions too. She'll be gaining some fans in the banking world, that's for sure. Bailey then confirmed that the bank sees that the rises have done about 70% of the work they would expect them to have done, up from 50% in November. They actually also put some colour around the effective QT, which I'd personally estimated before, at 10 to 15 basis points. That's exactly where I had it, which is pleasing. So effectively the real interest rate at this time is more like 5.4% than 5.25%. The chair finished in a meaningful although oversimplified way. A is the risk of over-tightening, which is just staying at higher rates for too long, and B is the risk of the labour market and wages staying too tight and increasing much too quickly. Which is the bigger risk, she asked. Dingra basically said A, of course. That's why she's voted down at the last meeting. Green said B, just about, but said A and B were close. Bailey and Broadbent, once again group thinking as called, said A and B were balanced in their views. My own view is that Bailey contracts his thinking out to Broadbent, not groupthink, just intellectual theft. I can almost see that when he took the gig. He said, listen Ben, you're next up in line. I just need for you to tell me what to do for 8 years. Seems reasonable. Unfortunately though, Broadbent is approaching the end of his second term, and it seems like he's off. So whose views will Bailey adopt next? I hope you enjoyed this week's episode of Economic EastEnders. No one was shot or died or slept with anyone's sister, so I appreciate this wasn't primetime viewing, but still, these insights are absolutely key if you even want to attempt to understand what's driving interest rate policy and, by extension, the bond markets, and by further extension, the property market. The market feels quite tight, static, and stuck around the 4% 5-year bond mark. Margins are thin, but they can be thin when volatility is down, which it is. We need to avoid any real, major, not press-generated crises before the next bank meeting. Thursday the 21st of March, less than 4 weeks away. Well, that's quite likely. That's the day after Feb inflation numbers are announced, and the week after Feb's GDP is announced. Wages and unemployment will also be out for Feb by then. Let's see where the chips fall on that meeting, but it's definitely timely. Remember that we need that meeting first of all, where everyone votes down or to hold before we can expect a cut. Short of an emergency situation, the first cut simply can't be until May, and it is much more likely in my book that May is the first no-up vote meeting rather than March. That still wouldn't guarantee a cut in June by any means, but at least it would be a live vote. If Mann had been at the Treasury Committee, I could be more sure, because she seems the hawkiest hawk. Broadbent's replacement is either a Hunt advisor, Lombardelli, with a long history of public sector work, or Vliga, who has already done 6 years on the MPC as an external. From his 6-year voting record, he looks to be a light dove, although his 6 years, which were 2015 to 2021, were not full of interest rate changes. There were a few, mostly downwards, thanks to the referendum and the pandemic. If this was a football team, Broadbent has got 125 caps, and it's no wonder Bailey shadowed him. Effectively, Beckham is retiring here, and only 3 in history had more caps. Vliga has 54 caps already, and would come in as equal top meeting attendee in a committee that otherwise looks a bit light on miles on the MPC clock. Although experience in the Bank of England itself isn't the only fruit, of course. Lombardelli looks more like a Treasury mole going in to make a difference before the election. Of course, it would be easy to go down a conspiracy theory route, but that might be incredible timing. So, who appoints the new Deputy Governor? Oh, let's just check the job advert on the government website. Candidates are sought for the role of Deputy Governor, Monetary Policy. This appointment is made by His Majesty the King on the recommendation of the Prime Minister and the Chancellor of the Exchequer. The appointment is expected to commence in June 2024. A fiver on Lombardelli it is then. I'll draw what's already too long, #sorry not sorry as always, to a conclusion with my findings from the bank breakfast briefing this week. The front row guy, me, asked 2 questions after a presentation which basically said, yep, we're cutting at some point, soonish, but not straight away. And more importantly, we agree with the forward curve. That's the first consensus or open statement of this for 2 years or more. My question 1 was, how concerned are we or should we be about services inflation? Answer, quite concerned, but it's going in the right direction, so calm down. I didn't rebut with, hang on, it's up for the past 2 months. I can't completely hijack the Q&A, but suffice to say I wasn't happy with the answer. Question 2. The rep mentioned that the MPC is expecting savings to go up. I was surprised at this, although I hadn't given it much, if any, thought before the rep reported it. The thinking here is threefold. Number 1, uncertainty in the job market in general, so people save more. Number 2, more attractive saving rates than in recent previous years. I can't argue with that, but they're trending down slowly as a rule. And number 3, uncertainty around geopolitical situations, baked in fear. A much more robust answer which at least addressed the question, and it's hard to disagree with that. My follow-up here would have been, okay, so how much and therefore how recessionary is this trend likely to be? Which is a question I'll need to try and answer myself in a future week. The data on savings is woefully slow to come out though, so I'll need to find a better real-time proxy to produce anything meaningful about this. When you look back for comparison, the savings ratio was between about 4 and about 6% after the referendum. Now the savings ratio is the percentage of a household's income that it saves. This spiked hugely during COVID, for reasons that you'll all be aware of, and then it settled between 6.6% and 10.1%. That's our most recent figure, which was Q3 2023. So I'd argue this is more pandemic PTSD, and we have been scared back into saving like we used to, rather than fairly safely consuming as we were between 16 and 19. What's a few percent between friends? Well, the magnitude here is a difference of 5% and growing. So I'm now told 5% being saved rather than consumed. Consumption is, remember, 60% plus of the component of GDP. So 5% of that is 3% of GDP. £75 billion a year. 75 billion. That's not subject to VAT, not in the circular flow of income, not causing inflation. I could go on with a lot of things that 75 billion is not doing. It would, though, of course, be earning about 3% a year if we took an average of the big bank rate and the Best Buy savings rate. That's 2.25 billion. Taxed at an average of 25%, shall we say? I know that's guesswork, but much will be retired people under the 40% threshold, and the rest will reside with those who do pay 40% and above. Well, that's 562 million quid that wouldn't be there otherwise in tax. However, imagine if it was consumed. Let's estimate that 90% would be on VAT registered goods or services, because not much escapes VAT, let's face it. The stuff that does is supposed to be essential after all. That's 13.5 billion in VAT that isn't taken in by HM government. That's just at the first pass, before we work out all the other taxes that money percolates down into: income, national insurance for the extra workers needed to supply those goods and services, etc., etc. Damaging things savings when you look at it like that. One thing that came out the meeting that reminded me, I'm only 80 to 85% sure we're out of recession this quarter. The PMIs keep me to the top of that range, or even push me to 90% after taking those into account. There's still a month and a bit to go, though, after all. It can't help you feel, though, that one real answer in solving some of the issues faced in the modern post-industrial capitalist democracy would be unlocking some of the wealth that isn't productive and doing something with it. I prefer a people-led solution to that rather than a red flag, Jeremy Corbyn, John McDonnell style solution, of course. I proposed one a couple of weeks back, enabling the Bank of Mum and Dad with HM government shaving a few much needed quid off the top. There are more. In fact, Hunt has been closer to unlocking them than anyone else for a long time, and at least is thinking down those lines. Sadly, out of self-interest and just bad timing, he now has an election to try and win with his possibly last real bullet in the chamber. That's with us on the 6th of March, the week after next, and you can guarantee there'll be one place to read and listen to it in the appropriate level of detail. The supplement, of course. So congrats as always for getting to the end, and don't forget that free Pip Taster evening on February the 26th. There will be a link in the show notes, and Rod and I will delight you. Okay, what do they say? Don't overpromise and underdeliver. At least we might briefly entertain you with our respective takes on the current market and the challenges coming in 2024. Alongside, of course, some more detail on the opportunities that will bring. So, until that event, and until next week's supplement, keep calm and carry on, of course.